A lot has been spoken about the Federal Reserve, the Fed funds rate, inflation is cooling, what exactly the Federal Reserve is going to do. So this video is all about explaining these terms to you. Like what is Federal Reserve? How does it impact the economy? What is the Fed funds rate? Like what interest rate are we talking about here? So let's start. Okay guys, let's try to first understand what exactly is the Federal Reserve. Guys, Federal Reserve is the central bank in the USA. That's it. Like in India, we have the Reserve Bank of India. In Canada, we have the Bank of Canada. We have Bank of Japan in Japan. Likewise, in USA, we have the Federal Reserve. And guys, Federal Reserve is an important body in the global economy because see, US dictates the world economy that we all know. US is one of the most strongest economy in the world and it dictates the world economy, and hence the central bank of USA, that is the Federal Reserve, is a very important body in the global economy. Now let's talk about the federal funds rate and the discount rate. These days in the news we are all hearing about the federal funds rate, Fed funds rate, or you can say the Fed rate. But we'll also try to understand what the discount rate is. So let's first start with the Fed funds rate. Okay, the Fed funds rate is the target interest rate that the Federal Reserve, that is the central bank in USA, sets at which different banks in USA lends money to each other. Like for example, the current Fed funds rate is 5.7% while I am talking in this video, while I am making this video. And so this is the target interest rate at which the banks of USA will lend money with each other. Now, what is the discount rate? The discount rate is the rate at which the Federal Reserve will lend money to different banks in the USA. So the interest rate at which different banks lend money to one another is the Fed funds rate, and the interest rate at which the Federal Reserve lends money to other banks in USA is the discount rate. So these two are very important interest rates which drives and impacts the economy. And hence we are hearing about these interest rates every day in the news. Now the question comes, who actually is responsible for setting this Fed funds rate? Of course, I said that the Federal Reserve is responsible for setting this target interest rate. But how does this happen? So this happens like this. Listen. So we have 8 meetings in a year. This is called the Federal Open Market Committee, which meets 8 times a year and they check the economic status and other factors, and henceforth sets the federal funds rate. So basis the economic situation and that, and we'll talk about it later, like how the economic situations, like different economic situations can impact the Fed funds rate differently. But for now, just understand that 8 times each year we have meetings, Federal Open Market Committee, FOMC, and the Fed funds rate are decided. Now we will try to understand like how the Federal Reserve works, like what is it that the Federal Reserve looks while functioning, like how does it function. So you have to understand that the Federal Reserve has a dual mandate. It has two mandates that it takes care of every time. Whatever it does is based on these two, or the dual mandates. What are these dual mandates? First is to keep the inflation stable. Like they have a target of 2%. Like in 2011, they have set this 2% inflation target. And when the inflation number or the indicator is close to 2%, they're happy with that. And second is keeping the unemployment in check. Like there should not be a high unemployment in the economy. These two are the most important mandate that the Federal Reserve works upon. But what is the tool that it uses to mend things? Like if there is if the inflation is not in control, or if the unemployment rate is high, so how does it combat with these situations? This is the tool that we're talking about here is the Fed funds rate. Yes, we talked about it, the interest rate which it sets. The Fed funds rate is the tool that the Federal Reserve uses to mend things in the economy. So, okay, now let's try to delve deeper into the matter. So, what happens is we have two situations. First is when the inflation is high, and when second is when the unemployment is high. Let's tackle the first situation. What will the Federal Reserve do when the inflation is high? Okay. When the inflation is high, the Federal Reserve will increase the Fed funds rate. We have seen a series of hikes in the Fed funds rate in the past, and this was in order to combat high inflation. And how does it work? When the Federal Reserve increases the Fed funds rate, then the interest rate at which the banks lend money to each other increases. Okay. When this interest increases, then in turn the banks also increase the interest rate at which they lend money to the consumers or businesses, and hence it is hard to borrow money from the bank, and hence money is not easily available in the economy at this point of time. Now what happens is that with this less of money in the economy, businesses will hire less, will produce less, the production will go lower, hiring will go lower, and hence the unemployment rises or the employment decreases. So businesses do not hire because the production goes down. So in this situation, what happens is now the Federal Reserve now needs to inject money in the economy. And how will it do? Again, it will use its tool of Fed funds rate. It will decrease, have a series of rate cuts like we are anticipating in September and November. That is something that we can talk in another video. But then the Federal Reserve, what it does is it reduces these rates, and hence it becomes easier to borrow money from the bank, and hence there is more money in the economy, and as a result more jobs, more production, more hiring, and the unemployment rate is checked. Of course, these are not the only two scenarios on which the Federal Reserve decides like how should it conduct its procedures and processes. There are other factors also on which the Federal Reserve decides its monetary policies. They can be gross domestic product, consumer spending, and industrial production. They can be major events like a financial crisis or a COVID, like that happened in 2020, a global pandemic, or a massive terrorist attack. So, all these things are the factors on which the Federal Reserve decides its monetary policies. So, as you can see in the graph, the Fed funds rate has seen troughs and crests starting from 2000 to 2022, and you can see highs and lows in the Fed funds rate. In fact, you can see close to 0% the rate was when it was 2020. In fact, January of 2022 it was 0.08%, and then you see a sharp increase in the rates, because at this point of time in 2022 the inflation was so high. Federal Reserve had to increase the Fed funds rate so that, as I explained, the borrowing could be difficult, and hence money is there's a dearth of money created in the economy, and hence the spending is low and the inflation could be controlled. Okay, so now let's talk about the current scenario. We will discuss the period starting from COVID till now, and we'll see how the Federal Reserve used the tool, that is the Fed funds rate, as we discussed, to fight the inflation that occurred, and now it is using it to fight the unemployment growth or the weakening labor market. So let's see how it used this tool. Post COVID, you know that the inflation rose to an unprecedented number. In fact, in June of 2022, if you see this graph, the inflation was 9.1%, which was way higher and way more than what it was a year earlier when the COVID started. If we discuss some of the reasons why inflation happened post COVID, some of the reasons were supply chain issues. There was a housing crisis, and the government has also infused funds to stabilize the economy. So why supply chain issues? Because the COVID had disturbed the supply chain. People were not able to transport goods from one place of the manufacturing to other place where the good is to be used. So that's why there was a dearth of uh, products and services in the economy, and hence the prices rose. There was a housing crisis because there was a lot of immigration happening in the USA and Canada at that time, and the houses that were there at that time were pretty less in number to accommodate these immigrant people. So that's why the prices of these houses grew up to an unprecedented number. And there were other issues also, like the economic stimulus from the pandemic. So the point of the matter is that the inflation rose post COVID. So as we have seen earlier in this video, the Federal Reserve responds to rising inflation by rising the Fed funds rate. So basically, it increases the interest rate at which the central banks borrow money and lend money among each other, so that there's a dearth of money in the economy, and hence we can fight the inflation. In fact, the Federal Reserve made a series of rate increases from a range of 0.25% to 0.50% in March 2022 to 5.25% to 5.50% in July 2023. So as you can see in the table, the Fed funds rate was in a range of 0.25% to 0.50% in March 2022. Then a 50 basis points was increased to 0.75% to 1% in May 2022, and this rate increase happened over a series of cycles, and finally it rose to 5.25% to 5.50% in July of 2023. Just to note here that the Federal Reserve typically represents the federal funds rate as a range. For example, instead of setting a single specific rate, the Fed might set a target range such as 5.25% to 5.50%. This allows for some flexibility in how the rate is implemented in the market. You should also understand basis points. One basis point is equal to 0.01%. Hence, a 25 basis point increase means an increase of 0.25%. A 50 basis point increase means an increase of 0.50%, and likewise. Now, as we can see with this series of rate increases by the Federal Reserve, the inflation got checked, and currently it was recorded as 2.9% in July of 2024, which is very close to the target 2%. But as we know, when the rate increase happens, the ease of borrowing money from the banks is difficult, and hence there is less money in the economy and the unemployment rises. So as a result of all these rate increases that the Federal Reserve did to fight the inflation post COVID, we are now witnessing a high unemployment number. In fact, the recorded number is 4.3% in July of 2024, which rose from 3.5% in July of 2022. So now if we just revisit the series of events that happened post COVID, first the COVID happened. It resulted in supply chain issues. There were economic stimulus given in the economy. There were housing crises which led to inflation. The Federal Reserve wanted to curb the inflation, so it made a series of rate increases. Now the inflation is contained from as high as 9% in 2022 to 2.9% in July of 2024. But this inflation is contained, but this made unemployment to rise. So the current scenario is that there is a high unemployment and the labor market is weakened. Now what? What is the next step that the Federal Reserve will take to combat this weakened labor market? So as you remember, the Federal Reserve has a dual mandate of checking the inflation or keeping the inflation stable and also keeping the unemployment in check. So now when unemployment is high, what should the Federal Reserve do? The Federal Reserve will now cut interest rates. So we will witness a series of interest rate cuts by the Federal Reserve to combat this growth in unemployment or the weakening of the labor market. It will cut the interest rates to inject money in the economy, hence increasing the consumption and hence increasing the production, and hence more hiring will be done, and hence the unemployment will be combated. So now that we have understood the Federal Reserve, the Fed funds rate, and also seen the current scenario of starting post COVID till now. Now we should see what are the impacts of the federal funds rate and the Federal Reserve on the economy. In this video, we will talk about the impact of the Fed funds rate and the Federal Reserve on the stock market and the housing market particularly. We would also try to understand how the anticipated rate cuts by the Federal Reserve in the coming months and the coming year would impact the housing market and the stock markets in general. Okay, so let's start with the housing market. First of all, understand that the federal funds rate has not a direct correlation with the housing market. However, the federal funds rate impact the sentiments of the buyers of the houses, and hence indirectly it actually impacts the housing market. In the past, it has been seen that changes in the federal funds rate have impacted the housing market also. Let's see how. One correlation between the federal funds rate and the housing market can be seen by comparing the rate or the interest rate, the federal funds rate, with the mortgage rate. I mean the rate at which you buy houses, the interest rate. So if we compare these two interest rates, the federal funds rate and the mortgage rate, we could see a correlation between the two, and we can predict like the anticipated rate cuts could have an impact on the housing market or not. Let's see. If you could see the data for the past 30 years in the comparison graph, the blue line represents the mortgage rate, whereas the gray line represents the Fed funds interest rate. You can find that both the graphs move through their troughs and crests in a similar fashion. Hence, the Fed rate cuts are likely to influence the housing market mortgage rates. Another correlation can be found by comparing another housing market index, that is the housing affordability index, with the federal funds rate. So what is the housing affordability index? The HAI, or the housing affordability index, is an index or a metric, a measurement given by the National Association of Realtors, in which higher scores indicate more affordable housing. That means if HAI is high, then the affordability of the house buyers is also high in the economy. If you can see this graph, the pink line is the federal funds rate, the movement of the federal funds rate starting from December of 1993 till December of 2023, and the blue line is the housing affordability index, again starting from December 1993 till December of 2023. Although there is no strict correlation between the two indices, however, we can see that there is a relationship between the two, and when the federal funds rate change, the housing affordability also changes. Not every time, but we can get an idea from this graph. So when now we know that the Fed funds rate does not have a direct correlation with the housing market. However, the sentiments of the market after a rate cut or a rate increase might push the mortgage rates lower and hence give a push to the housing market. Although, as I am saying again and again, keep in mind that the mortgage rates are not directly related or correlated to the Fed funds rate. In fact, they depend on another index known as the Treasury yields. If you want, I can make a video on that also. But let's say with the anticipated rate cuts that are happening in this September and the coming months by the Federal Reserve, let's say the mortgage rate also reduces and there's a push in the housing market. But the subsequent question comes as, when the mortgage interest goes down, will the prices of houses go up, since now the demand of houses might rise? Because see, what happens is the mortgage rate goes down, so everybody can now think of buying houses. So then the demand increases. Will it further push the price of the houses? If I am to answer in the current scenario in US, my answer to this question would be a yes and a no. Why no? Because already the prices of the houses are soaring high. People are not able to afford houses because of the soaring high prices of houses. So just a nominal reduction in the mortgage rates would not encourage them to be a buyer of the houses, and hence the demand of the houses might not grow. Because see, what happens is the house prices are already high. You're not able to afford houses in the US, and there's just a nominal reduction in the mortgage rates. So the amount of money that you need to buy the houses is not changed by a lot, and hence you are still at the same position where you are not able to afford the price of the houses. So hence the demand will not grow, and subsequently the house prices will not grow also with reduction in the mortgage rates. But let's say this mortgage rate reduction is substantial. There's a substantial reduction in the mortgage rates. Then yes, it might happen that there is a lot more demand for housing in the US and the price of the houses may rise to an unprecedented level. Okay, now let's try to understand the impact of the federal funds rate and the Federal Reserve decisions on the stock market. Generally speaking, these two things are inversely related. That means when the federal funds rate increases, then the stock market falls, and when the federal funds rate decreases, then the stock markets rise. But please understand that this rise and fall in the stock market with the fluctuations in the federal funds rate is not in a straight line. But overall, the impact of the fluctuations or the changes in the federal funds rate are seen in the stock markets also, and we'll talk about that. I think the biggest reason for this inverse correlation between the federal funds rate and the stock market is that when the rate increases, it is more difficult for companies to borrow money, and hence the production is sacrificed, hiring is sacrificed, and hence their stock prices are also sacrificed. And when the federal funds rate are reduced, then it is easier for them to borrow money and to increase their production, to increase hiring, and hence the stock prices go up. We can in fact understand this inverse correlation between the federal funds rate and the stock market. See, when the federal funds rate increases, then it is difficult for companies to borrow money from the bank. Hence, they have less capital and low cash flow stability, and their stock prices suffer. However, please understand that there's some sectors that are directly correlated with the Fed funds rate. For example, the financial sector. Because what happens is when there's an increase in the interest rate, then the banks or the financial sector earns more by lending money, and hence their stocks will go higher. So the financial sector has a direct correlation normally with the federal funds rate. We should in fact see some of the past data to testify the facts that we have spoken, or testify the things that we have spoken till now. Let us now check the data taken from Schroders. This is a blog which tabulates 22 past US Federal Reserve rate cutting cycles since 1928 until 2019. It also presents the US stock market growth or decline in the following 12 months post the first rate cut. The green ones depict a growth in the stock market. We can see that in these 22 cycles, the stock market rose 18 times. The average return seen was 11%. Add to it the fact that in 16 of these 22 cycles, the economy was either in a recession or entered into one. Another data I have picked up from another blog, a Wealth of Common Sense blog. It is a nice one that I do follow for market insights. My fellow YouTuber, in fact, Clear Value Tax, has also correctly referenced this data in one of his videos. Now, this data depicts the S&P 500 returns after 1 year, 3 years, and 5 years, following the first rate cuts in the years starting from 1970 till 2019. You can clearly observe that in the 5-year period following a rate cut, the S&P 500 has consistently risen with an average return value of nearly 84%. The 3-year period after the first rate cut has generally shown positive returns, with the exceptions of 1971, 2001, and 2007, when the S&P 500 experienced negative returns. Following year has also generally seen positive returns for the S&P 500, with the exceptions of 1973, 81, 2001, and 2007. Hence, we see from all the data that we presented that the stock market has mostly seen positive returns after rate cuts from the Federal Reserve. But one thing that we should be noticing here is that more than the rate cut, the reason for the rate cut is much more important metric to follow. Some of the reasons for the Federal Reserve to cut the rates can be first recession, and second when the inflation is cooling. For example, now in the current situation, the inflation is cooling, contain the inflation or make the inflation stable, which is very close to 2%. Then the rate cut can happen. Also, the rate cut can happen in a recession or something like COVID, when when the Federal Reserve wants to infuse money or economic stimulus in the economy. So when the rate cut happens to stimulate the economy, generally we have seen the stock market to rise.